Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, April 4th, 2025. It's 9:19 a.m. Eastern Time. Rarely do I start videos before the market opens. I just, I've been at my desk for a while now. Watching, got up early to make sure I was watching what was going on in the futures, and saw the big slide down start around, what did I tell you, 6 a.m., I think. And 6 a.m. China announced reciprocal tariffs. As I said in that post I got out to you, a lot of what I'm going to do now is redundant. You got the levels. Keep in mind, guys, it takes a long time. If you look from when the first chart's screenshotted to kind of screenshot, annotate these things, there's a lot of stuff on the back end, get them uploaded, compose the post. Sometimes, if I can, I'll do a cursory proofread. Still, a lot of typos will come through. If you have any questions on any typos I made, clarify, ask in the comments section, and I'll try to address that. But either way, also in a fast-moving market, there's a lot of stuff out there. So what I'm going to do is kind of hit on the trades, my thoughts. When markets move like this, there's a lot of money to be made or a lot of money to be lost. So yeah, I try to speak to both of those over the years. I've certainly made a lot of money in the markets. I've certainly lost a lot. The markets are an expensive teacher. You learn some expensive lessons, and so that's part of what I do here. I try to pass along. I've been trading for decades, and try to pass along when I see opportunities to make money, what it looks like, how to trade it, and also how to avoid the pitfalls. So, as I said this morning, and it's not to be wishy-washy, we're at the point I talk about the rubber band stretching. Most people say a rubber band stretches, it's going to snap back, and that's usually the case. Pick up a rubber band, do this now. If you, obviously you don't have to literally do it, but if you want, pull it as far as you can. You hit a point that rubber band is going to snap, and then when it snaps, your arms go in the opposite direction, not back together. They go further apart. That's ugly. That is, as Warren Buffett once said, that's, when the tide goes out, you see who was swimming naked. I have little doubt, zero doubt in my head, there are hidden landmines in the financial markets. There always are somewhere, but after a big flush out, think the 2009 lows, 2010 bear market, after a true, real recession, which we have not had since the financial crisis. And even then, what happened after COVID? COVID was, by all metrics, a bear market. But what happened, and this started happening back in 2008 and in the 2007 to 2009 bear market, the Federal Reserve came in taking extraordinary and excessive, in my opinion, measures, bailing out the banks for reckless behavior back then. I can go on and on. So what I'm trying to say is that they've created the biggest bubble in the history of the world, in my opinion, of unforeseen potential buried risk. Now, I'm not calling for, the end of the world financial Armageddon right now. I'm just trying to say, when you continue to bail out bad behavior, like the big banks in the financial crisis, then just 2 years ago, the regional banks doing the same thing, not managing risk properly. In my opinion, I told you at the time, I don't think it was. I think I could use the word criminally negligent, because those for those regional banks that were managing the bond portfolio, what I was harping on at that time, and for the year or two up to it, there was zero upside potential in bond prices. When rates are at zero, you only have downside risk, because bond prices, as the Fed has said, they're never going to take rates negative. And Powell said that before, and previous Fed chairman have. So, back, and I'm talking back coming out, when the regional banks started failing, a couple of the biggest bank failures in history, Silicon Valley and the likes. Again, that is, it shows you that, it's like a game of whack-a-mole. Where's the next issue? We didn't know. I didn't understand. I knew there's embedded risk, and I didn't know to look in the regional banks that they were marking these treasuries to maturity, and had this, huge unrecognized losses that can be concealed on the books, and were, until it came out. In other words, you guys know interest rates started going up, and so the value of those long-term treasuries. And why on God's green earth would the banks have so much money in long-dated treasury bonds, knowing, again, that you have a virtually a 100% guaranteed risk of loss on those over a 30-year period. The only way you don't lose on a 30-year bond that you buy when rates are now near the floor is if rates for 30 years stay. The Fed keeps a zero interest rate policy for 30 years, meaning there's no inflation. They don't ever have to raise rates. And again, the probability of that was near zero. So, and that's why, in my opinion, that wasn't negligence. It was actual criminal negligence. Again, you must know those risks. I'll get off that. That will pop up elsewhere in the next bear market. Now, does it pop up? I'm saying that the next kind of what was this company doing? What was these non-bank lenders? That market's grown huge. Private equity, what do they have going on? So you'll see things, hedge funds that were over leveraged. That always happens during bear markets. Those things, quote unquote, blow up. I was talking just recently about those senior loan funds that pay the very high dividend. They use leverage to get that, enhance the yields. Those are the prime rate funds, are also known as, and those will also, things like that tend to go down very hard in a financial crisis. So again, are we there yet? That point could start to come now. Now the odds to me, the way I look at it, like just about everything in life, you smoke enough cigarettes for long enough, you smoke a few a day, or do you smoke 3 packs a day? Do you do it for a couple of years, or do you do it for 20, 30 years? Your risks go up for lung cancer at least linearly, if not exponentially, the longer you go on. And that happens too. And so, 2022 was the last bear market, but it was a very orderly and relatively mild. Again, I view it as just a correction, the first corrective wave in a much bigger bear market that's most likely peaked here. It was orderly. An orderly drop doesn't break things typically. Fast drops. So here we are. You can see so far. Let's just look at it. So if you take the highs recently to this where we hit today, which was that second target for that, give you these long-term targets. You can see all the way down to T7. Those are laid out last year. So far, it's been a nearly straight drop of about 20% in the NASDAQ 100. The first drop down before from the highs, I'm trying to grab without moving the trend lines. I'm grabbing a hair below, so I'm going to go down to where the first decent counter trend rally came from. That was a drop, also about 20%, but it took a lot longer. You can see, measure it in time from the peak to the trough there, or let's just even go to the first trough because you had a double bottom. That took 3 months. This one right here, when I grab the candle, my pop-up box to the left tells me it took 1.4 months. So over twice as fast to drop the same amount. That's a much more, that's what hurts and catches things, people, institutions, hedge funds, pension funds, leverage funds like those senior floating rate funds. When I mentioned back in the day, I used to sell the Van Kampen prime rate fund, but long before the advent, shortly before the advent of ETFs. And that was one of the first, what they call senior loan or prime rate funds. Somebody asked about it, so I talked about it the other day, one of which being right here, JFR. This is one that I track. Oh, hey, sorry about that pause. I was took a sip of my coffee, and I was looking at price alerts. I don't know if you hear the bells going off. Let's just do that right now. Let's look at my price alerts today. I've had so many fire off, but here's what's gonna happen. A lot of these are sell signal alerts, but because the market was gonna gap down, I'm just gonna go over them because they're also potential setups. See that one hit the trend line, but I wouldn't short it yet. T-Mobile, TMUS, it's on the trend line. I got an alert right now, or this morning, 9:48. That was my last alert because it hit the trend line. Now, if it breaks it, that's a sell signal. 1, 2, 3. You can see in my minimum target, and this is a setup, guys. Take these, mark them up, and I would just, like I said, I'd prefer it to see a bounce. But if the market melts down, this guy's going all the way here. So you have the downside potential for T-Mobile is about 15-16%. That one just went off. ARES, this one went off today because it took out that trend line. I would have covered this one already. Yeah, I did cover this recently in one of the assets. it is. Let me draw it here. Roughly right here. You can see I put that line. This is my, oh, here. You can't see the chart. I grab it here, put it down. This is at 18-month candles, 18-month daily candles, and you can see crude right at support. There was that other reaction low right there. So crude is at support, oversold. This is the 30 level right here. I don't have the lines on this chart. And you can see we're oversold there, oversold there, oversold there, there. You don't always bounce at oversold. The first one, sometimes you get a second oversold reading. Sometimes it's one and done. That one had 2 there. Oh, there it is. So basically, so far, looks like 1, 2. You get the first oversold, then you go lower, and the second oversold did the trick there. You get the first oversold reading right here, then you go lower, then the second oversold did the trick. You get the first oversold reading right there, then the second oversold did the trick. And right here, you get the first oversold reading right there, and we'll see if the second oversold does the trick. Okay, guys, that's it for me. I'm going to wrap it up here. Bitcoin, actually, I'm going to just said I'd wrap up. You know me. I love this stuff. I'll talk till the cows come home. Bitcoin has held up very well recently. And it's at nice support. This is the actual crypto BTC, my 5-month, 2-hour candlestick chart. It's been holding this level right here. I have a series of support. It's a support zone, but we're at the first one, and I use Bitcoin futures as my trading proxy. We also have the Bitcoin trade ID on the site, IBIT, but this level here, it's 81,329, I think that is, on the futures. It's the bottom of that big gap right there in the futures, and we've had a couple reactions through it, but lately right on it, and there's a downtrend line. So Bitcoin, I think, has the potential to scream if it can take out this line. I have one failed breakout attempt, but it's a pretty good downtrend line, and there's a secondary downtrend line. So if the stock market rallies, Bitcoin will almost rally at a multiple thereof. That cuts 2 ways. So you just heard in my head that if the QQQ rallies, 10%, Bitcoin's going to probably rally 30. Yeah, that's true, but it goes in the other way, other direction as well. If the market and Bitcoin breaks this support, Bitcoin's going to fall more. How do you trade it? You just adjust your position size down. If your number is 10,000 or 100,000 in QQQ, whatever your number is, then only put 3,000 in Bitcoin or 30,000 in Bitcoin. That's how I trade. That's what I call beta adjusting your position size. That allows you to allow wider stops in percentage terms that are still going to only cause you to have the same dollar loss you'd have on that QQQ trade if you're stopped out with your regular stop parameters. Likewise, you only need a third of position size to make the same amount of dollar gains because your upside profit potential in percentage terms is a lot higher. So there it is. I like Bitcoin if the market rallies, which I think so. There's a target right there for you. I should have put that in there. The 2 trend lines, 89,066. So let's just call that right now my preferred swing target. That is, at this point in time, that is, I grabbed that line. Now I can't move it. I think it was about a 10%, 9. Yeah, it was about 9, 10%, if hit. And again, it's like all these things, like the market. You just take it with a stop somewhat below. Or you don't. You wait for your next setup if you don't like it here. I'm still talking because I wanted to update that GDX trade. I highlighted the objective entry yesterday for you right here on the back test. Remember, we went down, we broke down from the wedge, had a reversal off that, and these are all the levels on the chart. So that one we hit support. My sold target's still here. We're getting close. I just wanted to update you there. We're getting very close to that first price target on GDX. So if you took the short yesterday, you're already up about 7% on that one. And if you use dust or nugget, dust, well, you're up twice that, but you also need to then adjust your position size down to half of what you would short in GDX. So it's really a wash anyways. In other words, always factor in the leverage on an ETF if you're going to use leverage ETFs, and make sure you adjust your position size accordingly. Remember, on the top side or right side of the chart.com, there's a little calculator icon. That's a position size calculator I came up with years ago. Use that. It'll help you with your trades and kind of quantifying your gain loss potential and help you figure out your RR and all that good stuff, risk reward ratio. Okay, now I will wrap it up, but I did pretty good here, 15 minutes. I might have paused and while I was recording on one part of the video, so I'm going to listen to this video after I publish it, and I may follow up because I hit the pause, unpause, and I noticed a couple times the video was still running, and that tells me I may have clicked wrong. It's hard. There's a little control panel when you record these videos, and the pause button is kind of sensitive. It doesn't always take your clicks if you're not centered right on it. So I'm going to look at the video and see if I missed anything. And if I did, it'll be in the comment section below that video after I publish it. So check back. This has been Randy Finney with Right Side of the Chart. Have a great day.